Hi, everybody, and welcome to our third quarterly investor call of 2024, and thank you for joining us today. This call is being recorded and will be available for replay by visiting our website, clicking on the Resources tab, and then clicking on Quarterly Investor Call. And before we get started, we must remind you that the purpose of today's call is educational, and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. Please visit our website or YouTube channel to view the recording of this call or any previous calls.
Thank you, Carly. And thank you all for being with us today. I'm joined by Dominick D'Angelo, our Director of Research, and Peter O'Keefe, our Chief Investment Officer today. And the format for our call today is I will be emceeing the open Q&A format that we have for today. So we have a couple of prepared items to discuss regarding new purchases that we made in the portfolio this past quarter. Alibaba and PRGO. So we'll talk to Peter and Dominick about those purchases. We've also had quite a bit of inquiry about the investments that O'Keefe Stevens has that touch the artificial intelligence or AI marketplace. And so we do own some of these companies, and we wanted to talk specifically to the businesses that are making AI possible, but also Dom will chime in and talk about how AI is literally touching almost every business that we own, with very few exceptions, and how that technology is going to enhance productivity and output at various different companies that we hold in the portfolio. And then we'll wrap up with some comments, prepared comments on the research trips that we have this year, on what the team on the research side is doing to further our knowledge and understanding of investments we own and may own someday in the portfolio. And then we'll open up the line, so to speak, for your questions that we'll field as they come in. In the meantime, while we're talking, if you think of a question that you'd like to ask Dom or Peter or me, just type it into the chat box, and the order that those questions come in is how we will answer them. So I have a couple already that were submitted, and we'll start with those ones at the end of the call. And if you think of any others, just type them in and we'll read them as they come in. With that, I'm going to ask the first question to Peter, who led the research that we did on Alibaba. Peter, why don't you start by telling us a little bit about this company and what makes it an attractive investment that we hold in the O'Keefe Stevens advisory portfolio?
Sure. Thanks, Justin. First, any investment that I typically look at, we're looking for things that are unloved and unwanted. And so while there's plenty of things right with the business, there's also things that are wrong. And that's the reason that it's trading at such an attractive price. So Alibaba operates numerous online and mobile commerce companies in China and internationally. And it's the largest online company in the world in terms of its gross merchandise volume. The company went public in 2014 and has had tremendous growth during the past 10 years. The stock, in terms of its high low, it peaked at $320 in 2020, and it's recently we picked it up just under $70. Which is very close to its $68 initial public offering in 2014. So they have about $140 billion in assets, and they have profits of about $16 billion for the most recent years. And the profits have grown pretty dramatically. They've grown from $4 billion in 2014 to $14 billion this past year. And the revenues have gone from $4 billion to, let's do that again. The revenues have gone from $12 billion to $138 billion, and profits have gone from $4 billion to $25 billion over the past 10 years. Certainly the uncertainty of the relationships in the United States and the escalation of the tensions between the two countries. Chinese regulators have also been an issue with the company as well. Revenue and growth in China has slowed, and they had a decline in profits during the third quarter. So those are some of the things that have ultimately brought the stock down considerably. Alibaba dominates the China e-commerce market and continue to expand into Southeast Asia. They have a very strong balance sheet with about $75 billion in cash. They have another very significant ownership of several Chinese portfolios of other companies throughout the world. And they've been aggressively repurchasing their stock. And since we purchased the stock, they also announced a cash dividend of $1 per ADR, as well as a bonus dividend as well. So we think the opportunity is terrific. We always look at things from a standpoint of like we'd hope that a company would double over a 5-year period. So we're looking for about a 15% return on that. And naturally, since we're going to have some misses along the way, that's where our initial objective is. So we feel that that's a relatively modest scenario. It's unloved and unwanted, and it's exactly the kind of situation we think will be worth significantly more in 5 years from now.
Thanks, Peter. Before I go into the next question, Dom, is there anything you would add on Alibaba? No? Okay. So with that, we'll shift to the other purchase that was made across many portfolios in the last quarter. And Dom, you led the research on PRGO. Same question. Why don't you give us some background on the company and then tell us what attracted us to the investment from our perspective and why it's in clients' accounts today. Oh, I think you're muted, Dom.
Can you hear me now?
Yes.
Oh, sorry about that. All right. So just to give you an idea of what PRGO does, they provide over-the-counter self-care and wellness solution products. They operate in the U.S., so that's known as their Americas business. And they also operate internationally, which is known as their international business. And that international business is primarily dominated in Europe and specifically the UK. About 64% of revenue is generated in the US and 36% is generated abroad in Europe. And so if you look at the first picture, the Walgreens aspirin, that's their bread and butter business. Their private label business where they have partnerships with Walgreens, CVS, Target, Costco, many consumer brands. And these companies have private label drugs that instead of selling your top of the line drugs, you can buy these cheaper alternative drugs that offer the same exact same benefits, but just at a lower cost. And so that's their bread and butter. The business has been in transition over the past decade as they've made a lot of acquisitions and divestitures. In addition, they own a infant formula business that's had several issues that I'll talk about on the next slide. And then the last part of the U.S. business is a relatively recent development. They launched a contraceptive, so a female contraceptive called Opal. It's the first over-the-counter product that is it's the first of its kind. It was launched in March of this year. And then if we look at the international business, instead of just your private labels like it's done in the Americas or in the U.S., in the international business, they have their own labels and their own private brands. You can see here they've got Coldrex, Prevalin, Panadil, and again, that's 36% of the business. And so from 2010 to 2016, PRGO went on an acquisition spree. They funded a lot of the acquisitions with debt. In 2015, debt peaked around $6 billion. Today, it's around $4.1 billion. And the management team is laser focused on paying down debt with any free cash flow generated from the business. They recently just sold a line of business for about $200 million, and they said all of that capital is going to go towards debt pay down. And so if we look at the business back in 2010 to 2015, they had a generic drug business. They've completely divested of that and are now the new over-the-counter consumer healthcare company that they are today. In addition, they made a relatively large $2.1 billion acquisition in 2021 of HRA Pharmaceutical, and that was done to accelerate the transition to this consumer healthcare business. And so the question is, what is really gone wrong? Pete always talks about we want to find an unloved and unwanted name. 10 years ago, this stock was $210, and today it's around $27. So the obvious question is, what's gone wrong? And the answer is the acquisitions that they've made between 2010 and 2015 have not gone as planned. And when you fund these acquisitions with debt, you're left with an underperforming business with a lot of debt, and that is typically a recipe for disaster. When the market gets worried about your upcoming refinances, whether you can refinance the debt or not, higher interest payments, they typically will sell off the stock, regardless if it's fundamental based or not. And then if you layer on what happened during COVID, while everybody was taking pricing initiatives because it costs substantially more to manufacture everything, PRGO's strategy was, we're going to keep prices constant, take a hit to margins, but try and grow our market share. And instead, what happened was they basically maintained market share, margins declined, and the earnings per share and revenue numbers were below what everybody was thinking they would come in at. And to give you an example or a picture of this, in 2017 margins, so gross margins, that's just if you take the revenue minus the cost of goods sold, that's your gross profit. If you divide the gross profit by revenue, that gets your gross profit margin. So it's just what are the manufacturing costs basically to produce your product. In 2017, gross margins were 40%, and in 2022 they were 32.7%. So over a 7% decline in gross margins, and that amount all flows to the bottom line. There's really no, they try and make it up with volume, but that doesn't really work that well, especially when your market share remains relatively stable. And so today the company has about $4 billion of debt. Again, when interest rates rise, the market gets worried. When you have to refinance the debt, interest costs are going to go up. And so the stock has basically gone from 210 to 27 because they've had a lot of issues on the business, plus you have a lot of debt in a rising interest rate environment. And so over the next few years, what do we expect to happen? Well, the infant formula business that has gone through a couple of starts and stops in 2013 and Q3 2023, the FDA announced new guidelines and regulations about the manufacturing process. And basically now the manufacturing facility has to be cleaned a lot more, and there are tighter restrictions on basically what's allowed in the formula. And so PRGO had to shut down their facilities, resulting in lost revenue and earnings. And they're now just starting to get back the infant formula business. In Q4 of this year, they expect it to be sort of at a normalized run rate business. And then going into 2025, they expect it to be full systems go back to a normalized basis. And then the opioid drug that I talked about before, there was a study done in 2017 to 2019, and what it found was around 65% of women aged 15 to 49 use some sort of birth control. And so now that it's a lot easier to get access to, the thought is this is a large market that PRGO has not had access to before. It offers some upside in earnings and revenue, over the next decade as they penetrate the large market. So exiting 2024 into 2025, what do we expect? So we expect margins to increase as the company is now focused on taking pricing that they should have done several years ago. We expect leverage to come down as they use the free cash flow to pay down debt. We expect the Opel business to ramp throughout the year and then into 2025 to continue to gain market share. And then lastly, the infant formula business, they lost about $140 million in earnings due to all the shutdowns. We expect that to come back on a normalized basis. So in 2025, we think the company can do about $3.50 in earnings. They're probably going to do below $3 this year. But $3.50, typically consumer staple companies are high quality, very sticky because they don't fluctuate. The business doesn't fluctuate much with the economic cycle. 350, 13 or 14 times multiple. You could see the stock in the mid 40s is sort of where our fair value is at. And then the last part is that they've had a history of paying a growing dividend over the past 20. They've increased the dividend 22 years in a row, and the current yield is 4%, and we expect that to continue moving forward.
Yeah, thank you for that comprehensive report, Dom. And I would say in general, we don't find great bargains in consumer staples. And this was a obvious instance where we did find one, but it was because, as Peter pointed out, you have to shop in the unloved and unwanted bin if you're going to find businesses in that segment of the market, which usually doesn't fluctuate, tends to trade at a premium. So here we got a great consumer staples business for a very fair price. Great. Moving into the next section on the agenda, the questions keep coming up in our client meetings. Do we have investments in artificial intelligence? If you watch any form of media, pick up any newspaper, you're hearing all about artificial intelligence. So we wanted to talk just a little bit about the companies that we hold in our portfolio that directly contribute to the development of AI. So on the left-hand side, we'll start with Peter kind of taking us through those investments. We have NVIDIA, Corning, Qualcomm, and Alibaba on the left-hand side. And then Dom, I'll throw it over to you after that to talk about all the businesses that we hold that will benefit from AI, but may not be directly contributing to the development of the technology. Peter?
Thanks, Justin. The very first one, of course, is NVIDIA, and they really are the bread and butter of the AI revolution, of the GPU chips that they make that are in such high demand today. So that continues to be a great opportunity for them. Corning is the fiber optics. There's going to be there's been several articles in Barron's and other magazines, and we've recently seen the stock jump up in the last week considerably, and especially over the last month or so. And the fiber optics that they manufacture, artificial intelligence is going to require a lot more fiber optics, but also the broadband distribution throughout the world also puts them in a significantly wonderful position for the future in terms of that. Alibaba and it has a number of artificial intelligence areas, and also in the cloud computing area as well, that we believe that's going to propel them forward. Qualcomm, as 5G rolled out in late 2019, we see now there's going to be an artificial intelligence phone with Apple and other manufacturers as well, which should be a new generation of cell phones and turnover in cell phones that will make the cell phone much more attractive. In mid-June, actually, it was, Microsoft came out with a new AI computer, and all the Microsoft computers and laptops, the Hewlett-Packard, Lenovo, and others, and 15 others are all using the Qualcomm Snapdragon chip to power the artificial intelligence computer. So this is a brand new area for them, and we think the potential is terrific. And of course, all of these companies, you've seen significant price rise, except for Alibaba, which is a recent acquisition for us. And NVIDIA is priced for perfection at the moment. Qualcomm, while it has risen significantly, we believe that the profitability is just beginning to have a significant upsurge, and we'll see the same thing with Corning's earnings moving forward as well. Dom?
Yep. Thanks, Pete. So those are the companies that are basically enabling the AI revolution. Now the question is, who outside of them is going to benefit? And the answer is it should be every company should be incorporating AI or machine learning into their business. And just to highlight a few examples of that, Warner Brothers, Starbucks, Amgen, Bank of Ireland, you'll notice just a wide array of industries. None of them are that similar in companies. Some have, consumer end markets, but in general, they're all operating under different business lines. And so if we start with Warner Brothers, in the last writer's strike alone, one of the hiccups in the negotiations was a lot of the writers were concerned that AI was going to basically replace their jobs. And if you ever go to ChatGPT, you could just type in, hey, write me a script for a 3-minute play on, dinosaurs fighting or something like that. And it will write you a script for it. And so the question is there really going to be a place for human writers in the future? And the answer is there's probably going to be, but it might just be at a less of a scale. And so Warner Brothers, for them, that means lower content costs on the writing side. And then also there's technology getting created that's enabling just video generation without any actors or actresses. And so the cost to write content is going to decline. The cost to produce the content is going to decline. And that should ultimately benefit Warner Brothers. We should see their cost decline moving forward, and should lead to greater profitability. For Starbucks, you can think they have numerous amounts of consumer data, consumer spending habits, what they eat, what they drink, and you can think about them targeting different, demographics. Maybe they can find correlations between, a male that drinks black coffee and what they typically might order with that, and then send out ads or promotions saying, hey, we noticed you only buy a coffee. Why not try this food product as well? And hopefully that spurs incremental demand that they otherwise wouldn't see. Amgen AI is playing a significant role in their drug discovery and development process. In addition, you've got their molecule design. They can use AI to design new molecules that can effectively interact with new biological targets. It can also select better patients, determine who's an optimal patient to test on for different drugs. And again, the last part is Bank of Ireland. Again, you can think about how much consumer data they have, other loans. I suspect what's going to happen with a lot of banks is you're going to be able to automate a lot of the loan origination process, because you're going to see hundreds of thousands of the same applicants come through. And if you can use some sort of machine learning to understand, this cohort of individuals is typically of good credit, this one is typically of bad, it should improve their credit quality metrics moving forward. And also maybe the rate that they charge in some cases might be lower than optimal right now, but with machine learning and understanding the risks associated with different loans, could price loans better. This is just a small sample. Again, I suspect every single company moving forward is going to use AI or machine learning in some way. And if they're not, you're probably going to notice that they fall behind the competition that is using that technology. I think you're muted, Justin.
So absolutely, Dom, and the adoption of AI technologies includes companies like our own. I think in our last newsletter, I shared that, our new tax software allows us to upload a full tax return. It uses an optical scanning device to extract all that information and develop a really detailed analysis within seconds. So that type of computing, the ability to process large data, on the left-hand side of the screen, you're seeing all the companies that are making that technology possible. And you're seeing a small sampling on the right-hand side of the screen of some businesses that we own across the various portfolios that we manage, and how they will benefit from it. But the interesting thing that I see, and one of the things that keeps coming up, I attended a futurism conference a couple of weeks ago, and all about, what's going to change in the future. And it was brought to my attention that by 2025, artificial intelligence is going to eliminate 85 million jobs across the world. But also by 2025, it's going to create 92 million jobs. So Dom's point is well taken that, we're going to see efficiencies created. You have really, really smart computers that are able to process vast quantities of data. And now we're going to see human interaction with that data change, and basically the role that humans will play is to create comprehensive models that use that data to make their businesses more productive and more efficient and more profitable. So those were the prepared topics. I just wanted to ask you to touch on a couple of the things that we have in the works through the remainder of the year, and the conferences, Dom, that you're going to be attending, and then Peter, just the investment forum that we're going to be doing later this year. Can you guys spend just 2 minutes on that?
Yep. Yeah. So there's a company called 3 Part Advisors. I went to their conference a couple months ago, a couple weeks ago at this point. Typically a lot of smaller companies, but it's mainly 2 days of investment presentations from companies, and then also one-on-one meetings there. So they put on 3 different conferences every year. One's in New York, one's in Chicago, one's in Dallas. The one from August 27th to the 29th is in Chicago, and then the one from November 20th to the 21st is is in Dallas. Companies like GraphTech have gone there before. Newmark's a company I've followed for a while. They're there. So typically, again, smaller companies, but you get a wide array of industry attendees there. Pete, do you want to hit on the investment forum?
Sure. We had our first investment forum last October in Buffalo at the Historical Society. And this year it's going to be in Rochester. And the location has not been chosen yet, but it'll be on October 10th in the evening. So we hope you can put that on your calendars to attend.
Yep. And then in mid-November, Peter and I are going to go out to 5 Point Holdings from Friday to Sunday. And Friday, we hope to meet with the management team. We're going to talk with them, discuss the business outlook, what they have going on. And then we're also going to plan on going to their 3 different locations: Great Park, Valencia, and San Francisco. It'll be a lot of driving, but it'll be a good chance for us to get at least for me, Pete's been out there before, but I've never seen the land that we own. So it'll be a good experience to understand what exactly we own. And then what's interesting is right after that is Howard Hughes. They're another land development company. They own properties in Vegas, Arizona, Hawaii. They're putting on an investor day in their Summerlin community in Las Vegas on the 19th. And so it'll be really interesting to hear what 5 Point's management team says about their outlook versus what Howard Hughes is saying. They don't have a lot of land. They don't really have much land ownership overlap. But it'll at least be a good sign to hear how they're thinking about the different markets that they operate in.
Great. Well, that ends kind of our prepared questions for the call. I did have a couple of questions that were submitted via email, and then we've got some questions through the chat box already. So I'm going to start with the questions that were emailed to us. The first one came from Jerry, and the question is that things seem to be going positively for Fannie Mae as of late. What is behind that, and what do we think about what's going on at Fannie Mae with regards to our investments there?
Sure, I'll take that call. Fannie Mae continues to be one of the most profitable businesses in the world, but it still trades at a fraction of its value that we believe will be unleashed once they get out of conservatorship. It's still going to require a political and possibly legal solution before the value is unleashed and that investment. And certainly the presidential election is been part of the reason with the upswing that it's experienced to some extent. So obviously we're still a long way off from the election. As a matter of fact, in reading articles recently, the Democrats are highly divided up whether President Biden should even have the nomination. So we're not going to speculate on what's going to happen there, because I don't think I or anyone else knows at this point in time.
Thanks. Next question came in from Linda, and this question is about our investment in the Sphere in Las Vegas. She'd heard some people complaining about the motion sickness or vertigo that people may experience when they attend the Sphere, and said that is there any concerns over this issue in our ownership of Sphere Entertainment?
Yeah, I can take that. So I would say it initially was a concern. When you have something that has never been done before, there's typically going to be risks and consequences that are unforeseen. Up until now, I've heard on one-off or two-off occasions that people are getting, motion sickness or vertigo. But I think in the grand scheme of things, it's a very small subset of the population that is going to be unable to attend these events. If you go on Google and look at the reviews, there's about 10,000 reviews, and I think it's a 4.3 star. And that speaks volumes to people's attraction for attending these events. There's been numerous cases where I've seen people attend multiple, just Dead and Company concerts, even though a lot of it's going to be the same. Just they've loved the experience. So, in the beginning, I think if a lot of reports came out that people weren't going to be able to go to it, that would have been something to think about. Now that we're almost a year into it, and not much of that has surfaced, I'm not overly concerned with it. I think if you think about anybody, if that goes to an amusement park, there are going to be certain people that just cannot ride a roller coaster. There's certain people that can't take long car rides because they get car sick. Those people are unfortunately going to be like out of luck when it comes to the Sphere, but the majority of the population is going to be fine.
Great. Next question comes from Steve, and it's about two holdings. Any thoughts on the outlook for GrafTech and Green First?
Yep, I'll start with GrafTech. Obviously been a poor performer, and the business outlook is challenging to say the least. When we made our initial investment a couple of years ago, the thought of $4,500 per metric ton prices of graphite electrodes, especially considering all the inflationary pressures that we've seen over the past 3-4 years, that $4,500 figure was unthinkable to occur. That was the long run average between I believe it was like 2012 and 2020. We're back at those levels, and it seems like we're probably below $4,500 today. They just came out and said that they're going to try and separate what I assume to be Seadrift, which is their needle coke facility, which is primarily the thesis with the idea. It sounds like they're going to try and separate Seadrift and the graphite electrode facilities into two separate entities and recapitalize Seadrift with some debt, and then use that debt to pay off some GrafTech parent debt that's trading at, I think, 70 cents on the dollar. The market right now is very concerned with their debt levels, even though it doesn't come due for another 4 to 5 years because they recently refinanced it. At the upcoming 3-part advisors meeting in Dallas, I'm going to be talking with the CEO and the investor relations team. I have a feeling that's going to be, a pretty critical meeting. The outlook for the graphite electrode market and the steel industry is pretty challenging right now. The positive side is that there is a lot of demand coming online over the next 3 years in terms of the end market of the end market use. So I believe U.S. Steel has some steel capacity coming on that's going to need graphite electrodes, and several other steel manufacturers have the same capacity coming online. You need these graphite electrodes to manufacture the steel for their process. So that's the main positive. The issue over the next 12 months is they need to weather this downturn and figure out how they're going to make it to the upswing. I would expect some curtailments or some mothballed facilities over in India or Europe within the next several months, just to lower the supply amount, because nobody's going to be profitable at these levels. I would say except for the Chinese, because they're the lowest cost producers. Green First is such an interesting case. I in a group chat with one of the directors on the board, and they've actually executed incredibly well given the price of lumber where it's gone. When we made the initial purchase, I think lumber was somewhere around $1,600 per 1,000 board feet. Today, it's somewhere in the low to mid 400s. And if you look at the profitability of any lumber producer, I believe GreenFirst is one of the only profitable lumber producers at today's price, which is incredible given how small of a company it is. The issue the entire time has basically been they also own this paper mill that is just been a drag on profits. It was profitable for one quarter last year, and they recently announced that I'm going to say some sort of government entity provided the paper mill with $24 million of funding because it can't just be some normal, debt fund or hedge fund that gave them debt, because given the profitability and history of this facility, there's no way somebody seeking a return on their investment would actually give them an investment. So my suspicion is they got $24 million from the government, and they recently announced that because of that $24 million loan, they're going to be able to spin off the paper mill into a separate business. And so now moving forward, assuming it gets passed, there's going to be a vote in September. GreenFirst is just going to be a pure play lumber producer, and we're going to own one of the lowest cost lumber mills in the United States or in North America. The lower lumber goes, the more supply that comes offline. And if and when interest rates fall and the demand for repair and remodel and housing returns, that actually means the upside on lumber pricing is going to be higher because there is so much less supply in today's market. And so when we made this initial investment, it might have been like $1.20. I thought the upside was somewhere around $3. Even though we're standing at 30 cents today, if and when lumber prices rise, I actually think the upside is higher today because of how much supply has come offline in the lumber mills. And we're probably not at the bottom yet in terms of how much supply needs to come offline, which again only means when things normalize, the normalized price level for lumber should be substantially higher. So I remain very confident that investment is going to work out over the next 3 to 5 years.
Thanks, Dom. Next question comes from Carl, and it is that his read on those in the workforce that resist and do not embrace artificial intelligence in their everyday jobs will be those that lose their job to someone who does. Is there any evidence that there are companies starting with the aim of workforce development and understanding and embracing this pervasive technology? I will start by saying I don't have any evidence, but a lot of anecdotes that workforce development in AI is a very top of mind subject. But I know of no specific businesses that are publicly traded that are specifically focusing in this that we could make investments in, which is kind of how I'm reading the question. Any comments, Dom or Peter?
I agree with your comment.
The only thing I would say is I don't consider myself a computer expert by any stretch. And I've been using ChatGPT, and it's literally saved me. You put information in a request, it comes back immediately on things that might have taken two weeks to put together if you tried to do a complete scenario on your own. You type in 150 words asking what you want, and out comes a beautiful document, whether it be a marketing document, a succession plan, or a job description. And now it certainly needs editing, but it's a wonderful tool. And I only see the opportunity there continuing to grow and benefit not just the businesses we own, but virtually every business in the world. And those who embrace it certainly are going to be ahead of those who don't embrace it.
Yeah, Carl, to echo those comments, the Futurism presentation that I attended, it was a full day workshop, really got into the broader and like this second and third layer effects of artificial intelligence and you think there's a wonderful new technology that's developing, but there will be a boatload of unintended consequences. And so completely new jobs are going to exist because of artificial intelligence. I was talking with Dominic this morning as we were putting these slides together and reviewing them, that there's all sorts of biases that are getting programmed into the algorithms that run very important aspects of our everyday life. And there's going to be full fields of employment that open up that are there to protect and fact check and make sure that those biases aren't producing unintended consequences. So there's certainly going to be companies that find a way to develop and train employees to be better users of AI. And it's something that we'll keep our eye out for, but I know of nothing at the current moment. We're at the 40-minute mark here for our presentation. I haven't gotten any additional questions in the last 10 minutes. So what we'll do is, yeah.
We did
go
have
ahead.
one, Justin, sorry to interrupt, but in the
Sure.
Q&A portion of the presentation, we had one from Ed, and it says, any comments on WB Discovery's disappointing performance and what you feel is behind this, given how strong streaming services seem to be?
Thank you.
Sure. Yeah, I can start. The streaming is, I would say, is actually not that strong right now. All of the cash flow is coming from their legacy linear business, and call it primarily advertising based. Streaming is going to make up a larger and larger portion of their cash flows and revenue over the next, over the next decade plus. And the reason, call it, the performance has been bad is the company, when they made the initial acquisition of Warner Media, they've missed on a lot of their targets that they set out, and it was specifically related to the amount of debt the company was going to pay down every year. And then you throw in the writer's strike last year, that has delayed a lot of films, movies, TV shows for them. And so right now we're kind of in a lull period for that. They are still working through the integration cost-cutting measures that they laid out when they made the acquisition a couple of years ago. And I don't think those are fully in the numbers yet. The main question is, how much longer is basically the entire industry going to wait? I don't know if you've followed what's going on with Paramount, but they're looking to basically sell themselves right now. And that's because in the streaming industry, you need scale. You need to be able to spread the content cost across as many users as you can find. And so we've now seen some platforms go to what's called like a fast network, a free ad-supported tier, which is, instead of paying, you now have to watch ads every 30, 45 minutes. And that's how you're gonna pay for subscriptions. We'll see if Warner Brothers makes a move for Paramount, but they've got a lot of white space in terms of the international market that they need to execute on. That'll grow their subscriber base. That's going to be the next foray for them to see if the investment continues to work out, or takes a turn for the positive direction.
Pete, anything you would add on any of those questions?
No, I don't have anything to add.
Great. I think that wraps it up for today. Peter, Dominic, thank you for your thoughts and lending the wisdom that we've gathered on these different investments to share it in this format. Carly, do you want to end with some wrap-up comments here?
Sure. I'll just say that as a reminder, you can send in questions you'd like answered by our team via email prior to any of these calls. You can email any of us with those questions and we'll be sure to address them. And just thank you for tuning in. And again, you'll receive an email with the recording, and you'll also be able to find it on our website and our YouTube channel tomorrow.
Awesome. Thank you.
Thanks for joining, everybody.